Joining us now, Sarat Sethi, DCLA managing partner and a CNBC contributor. Sarat, thanks for being here today. Good morning to you, sir. As we think about the markets heading into next year, we talk about the benefit of taxes and the One Big Beautiful Bill Act ultimately trickling down into consumers' bank accounts in terms of tax refunds and benefits. How much of that is already priced into the markets that we're seeing right now?
I think you're seeing some of it, Leslie. The markets are staying where they are just because there is this enthusiasm that you're going to get some tailwinds. You're going to get it from the government. You're going to get it potentially from lower interest rates. And I think a lot of that is baked in, especially into the higher valuation stocks. We're looking at sectors that we think just have been underappreciated. And, there's been talk in the last couple of weeks of the 493. But I think if you dig deeper, you look at sectors like healthcare, you look at commodities, basic materials, they're just underowned and underappreciated. And I think most momentum investors don't really look at them and saying, hey, maybe I can trade in them. But we think there's more earnings power and long-term investing in those sectors.
Why do you think that's going to change in 2026? It feels like they've been underowned and underappreciated for quite some time now.
Well, take, for example, just commodities and basic materials. You're seeing copper, huge demand for copper. It's a proxy for industrial supply. We had higher GDP numbers. And if you look at copper, again, just basic materials, if you think the dollar is going to get devalued, so you've got a lot of money going into gold. And then you look at, we haven't had a copper mine built in 10 years. So a combination of inflation, industrial production, debasement, and these things are very small in the S&P. So you get any type of incremental demand, you can see stocks like Freeport and even Tech Resources do really well.
Yeah, I see Freeport, McMoran, and Thermo Fisher are the two specific stocks you like?
Yeah, and Thermo has just been, out of favor, like Danaher. If you look at their cash flow, their growth rates, and historically, they've traded at, 21, 22 times earnings. It's trading at 18 times earnings. We're getting demand back in biotech and pharma. This company is well known to a lot of investors, and we think, you want to be in high quality cash flow companies going into the next couple of years. Not to say you don't want to own the MAPs, the FAB 7. You can actually diversify and have earnings growth in other sectors and high quality companies that, not necessarily that you're playing in the weeds, but you want quality going into the next couple of years.
If you want cash flow and demonstrably so, Sarat, how do you see then the whole AI arena right now where there's so much credit going into this field, and so the hopes are so high for, I guess, a jackpot of a payoff?
Yeah, and that's why kind of diversification is going to work here, because initially it was free cash flow working for CapEx. You've now morphed into the SPVs and who's owning what. So really you want to look at companies that earn their own cash flow and own it. Yes, you can you can play in the other parts of those sectors, but I think when debt is very important here, and credit's going to be really important going into a latter half of the cycle. So to your point, yes, you can own them, but now it's time to really diversify, because underneath, we're not really sure where the liabilities lie.
What do you think is the best way to diversify next year, or as people are kind of thinking about their portfolio allocation? Is it international? Is it based on sectors? Is it based on other asset classes?
We look at it more on the sector basis. I think you can play international through investing in multinational companies in the U.S., but really it's a sector basis. So overweight, we talk about healthcare, commodities, even financials. Financials are going to really benefit. You've seen that this year, but even more as the capital markets open up, you've got more restructuring, more M&A activity. I think those are really key ways to play in the sector top down, and then bottoms up. Stock selectivity is going to be really important going into next year, because you're going to get companies that will have earnings growth, but the market as a whole is pretty fairly valued.